Hello, everyone, and welcome back to Management Accounting. In our last unit, we looked at the basics of management accounting itself, what it is, how it differ from financial and cost accounting, and the role of management accountant. Today, we begin Unit 2, Financial Statement Analysis. This is one of the most practical and widely used unit in the entire course because whether you become an accountant, an investor, a bank manager, or a business owner, you will spend your career reading and interpreting financial statement. So let's get started. In this lecture, we will cover six things in sequence: the meaning of financial statement analysis, the steps involved in carrying it out, its objective, its advantages, its limitations, and finally the major method used to perform this analysis. By the end of this video, you should be able to explain each of these clearly and even work through a small numerical example. Here is our roadmap for today. We will move through these six blocks one at a time. Keep this slide in mind. Every topic we cover will map back to one of these six boxes, so you always know where we are in the unit. Before we analyze financial statements, let's quickly recall what they actually are. Financial statements, formal structured record that summarize the financial activity, position, and performance of a business over a period of time and as on a particular date. The four statements you will work with most often are the balance sheet, which shows assets, liabilities, and capital as on a specific date, the income statement or profit and loss account, which shows revenue, expenses, and profit over a period, the cash flow statement, which tracks cash inflows and outflows, and the statement of changes in equity, which shows movement in owner's fund. Now, here the key idea for today: financial statements by themselves are historical. They just record what happened. It is analysis that make them meaningful, that turns raw number into insight. That's exactly what we are going to learn now. So, what exactly is financial statement analysis? Let's define it carefully. Financial statement analysis is the process of critical examining, comparing, and interpreting the figure presented in the financial statement so as to understand the profitability, solvency, efficiency, and financial strength of a business and support sound decision making. Notice three words hidden in that definition, which are really the three building blocks of this process. First, analysis, breaking complex data into simpler, meaningful elements. Second, interpretation, explaining what that simplified data actually means. And third, comparison, relating figures across year, across firms, or against industry norms. Put simply, we take a big complicated set of number, we break it down, we explain what it tells us, and we compare it with something. Last year, a competitor, or an industry average. So the number actually mean something to the person reading them. Financial statement analysis isn't a single, uniform activity. It can be classified in a two different way, and it's worth knowing both. The first classification is based on who is doing the analysis. Internal analysis is carried out by people within the organization, management or employee. who have accessed the detailed internal records. External analysis is carried out by outsider investor creditors, government agency who rely only on who rely only on the statement data published. The second classification is based on how the analysis is done. Horizontal analysis, also called time series analysis, studies figure across several years together to identify trend and growth. Vertical analysis, also called static or common size analysis, studies the relationship among items within a single year statement. We will come back to both of these when we look at method later in this lecture. Now let's look at how an analyst actually goes about this step by step. Step 1, understand the objective. Before touching a single number, decide why the analysis is being done and for whom. A banker evaluating a loan application need a different focus than an investor calculating a share purchase. Step 2, collect the statement. Gather the balance sheet, profit and loss account, notes, and schedule you'll need. Step 3, classify the rearrange the data, regroup item into homogeneous comparable heads so that say all forms of short-term debts sit together. Step 4, apply analytical tools. This is where the comparative statement, common size statement, trend analysis, or ratio analysis actually come in. And step 5, interpret and report. Draw conclusion from the analysis and present the finding clearly to whoever needs to act on them. These five steps from a logical sequence and skipping any one of them weakness the quality of financial analysis. Why do we go through all these efforts? Financial statement analysis serves several specific objectives. First, to access profitability. Second, to judge solvency. Third, to measure liquidity. Fourth, to evaluate financial stability. Fifth, to enable comparison. And sixth, to aid decision making. Notice how these objectives map directly onto real world question. It is the company making money? Can it pay its debts? Should I invest in it? That's exactly what financial statement analysis is designed to answer. Given those objectives, let's talk about the correct advantage this analysis brings. It simplifies complex data, converting dense financial statement into an easily understandable form. It reveals trend highlighting the direction of growth, decline or stability over time. It supports forecasting, providing a base of budgeting and future financial planning, both between different periods of the same firm and between different firms. It guided investment decision, helping investors judge risk and expected return before committing their money. And it assists credit decision, helping banks and other lenders assess a borrower's repayment capacity. In short, good analysis turns financial statement from a compliance document into a genuine decision support tool. It's also worth pursuing to It's also worth pausing to ask who actually used this analysis. The list is longer than you might think. Management uses it for planning, control, and internal decision making. Investor and shareholder use it to judge the safety of their investment and the return they can expect. Creditor and bank use it to assess creditworthiness before extending a loan. Government and regulators use it for tax assessment, policy making, and compliance check. Employee and trade unions use it while bargaining for wages, bonus, and job security. And researchers and analysts use it to study broader industry trends. Every one of these groups reads the same set of financial statement, but each is looking for a different answer. A useful as this analysis is, it's important to understand its limitation too, because number can mislead if we are not careful. First, it's historical in nature based on past data, which may not reflect current or future conditions. Second, it ignores price level changes. It doesn't automatically account for inflation, which distort comparison made over several years. Third, it can be affected by window dressing. Figures can sometimes be manipulated to present a more favorable picture than reality. Fourth, it based on estimate items like depreciation and provision rest on assumption, not certainties. Fifth, it ignores quality factor, things like management quality, brand value, and employee morals simply don't show up in the numbers. And sixth, it lacks a universal standard. Differing accounting policies across firms can limit true comparability. Keep these limitations in mind every time you read a set of financial statement. They are powerful tool but not an infallible one. Now we come to the heart of this unit, the actual method or tools used to perform financial statement analysis. There are four major ones. Comparative statement place figure of two or more years side by side to show absolute and percentage change. Common size statement express every item as a percentage of a common base, such as total assets or total sales. Trend analysis studies the movement of an item over several years against a base year index. And ratio analysis establishes mathematical relationship between related figures to judge performance. We will study in this detail in Unit 3. So today we will only introduce it briefly. Let's now look at the first three of these methods a little more closely with simple example. Let's start with comparative statement. Here a simple comparative income statement for 2 years. Notice the structure. For each line item, we show the figure for the earlier year, the figure for the later year, the absolute change in rupees, and the percentage change. Look at sales. It grew from 10 lakh to 12 and a half lakh rupees, an increase of 2.5 lakh rupees or 25%. Now compare that with net profit which grew from 2 lakh then 1000 or 3 lakh 35,000 rupees, an increase of nearly 6%. This is exactly the kind of insight comparative statements are built to reveal. Net profit grew far faster than sales. which tells us the company improves its operating efficiency during this year. It's not just selling more, it's also earning more from each rupee of sales. That single observation is the real value of a comparative statement. Next, common size statement. Here, instead of comparing 2 year, we express every item of a single year statement as a percentage of common base. For the income statement, that base is usefully net sales treated as 100%. This makes the analysis size neutral. A small company and a large company can now be compared meaningfully because we're looking at proportion, not absolute rupees figure. This is also called vertical analysis, since we're moving down a single column of one statement. In the example on screen, sales is the base of 100%. Cost of goods sold takes up 61% of sales, leaving a gross profit margin of 39%. After operating expenses of 12%, net profit works out 27% of sales. Common size statement let you instantly compare these cost structure with another company, even one many times its size. Our third method is trend analysis. Here we pick up 1 year as a base year and treat it as 100. Every subsequent year's figure is then expressed a percentage of that base. So we can see the direction and pace of growth at a glance. Let's quickly recap everything we have covered today. Financial statements record the past. Analysis is what make them useful for decision. The analytical process moves through 5 steps from understanding the objective to reporting the interpretation. The objective of analysis center on profitability, solvency, liquidity, and compatibility. It advantage benefit wide range of users, management, investors, creditors, government, and employee alike. Its limitation, historical cost at risk of dressing and ignored qualitative factors mean we must always interpret the number with some caution. That brings us to the end of Unit 2. In our next class, we will build directly on today's foundation and move into Unit 3, accounting ratio analysis, where we'll take the ratio method we will introduce today and study in it full depth. Before then, I had encouraged you to take any company published annual report and try preparing a simple comparative statement of its income statement, just like the example we saw today. Thank you for watching. Sejananda.